Look, I need to show you something that's happening right now in the precious metals market. Something that most investors won't realize until it's too late. And by the time they figure it out, the opportunity will be gone. Silver just crossed $67 per ounce. Gold is pushing past 3,000. And if you think this is just another bull run, you're missing the real story. Because what's happening beneath the surface is far more significant than the price action you're seeing on your screen. The physical market is seizing up. And I don't mean that metaphorically. I mean the actual metal is becoming increasingly difficult to source at any price. Let me explain what that means. In October, silver lease rates spiked to nearly 40%. Now, if you're not familiar with lease rates, let me put this in perspective. Normal lease rates for silver hover around 1 to 3%. They're boring. They're stable. Nobody pays attention to them. But when they spike to 40%, that's not a market signal. That's a market scream. Lease rates represent the cost of borrowing physical metal. When they explode like this, it means there's a genuine shortage of available silver in the system. Banks and institutions are desperate to get their hands on physical metal, and they're willing to pay extraordinary rates to borrow it. This isn't theoretical. This is happening right now in London, in New York, in every major precious metals trading hub around the world. And here's what makes this different from every other precious metals rally you've seen in your lifetime. The disconnect between paper and physical has never been wider. See, for decades, the precious metals market has operated on a fractional reserve system. Just like banks don't actually hold all the cash that depositors think they have, the metals exchanges don't hold all the gold and silver that paper contracts represent. They operate on the assumption that most people will never actually take delivery. They'll just trade the paper, take their profits or losses, and move on. But something fundamental has shifted. Industrial demand for silver has exploded. Solar panel production alone is consuming silver at rates that were unimaginable just 5 years ago. Artificial intelligence infrastructure requires massive amounts of silver for servers, cooling systems, and electrical components. Electric vehicles use significantly more silver than traditional cars, and all of this is happening while mine production has essentially flatlined. The solar industry is now consuming over 200 million ounces of silver annually. That's roughly 20% of total global supply. And that demand isn't discretionary. You can't build a solar panel without silver. There's no substitute that works as efficiently. Meanwhile, central banks have become net buyers of gold at levels we haven't seen since the 1970s. They're not buying paper gold. They're not buying ETFs. They're taking physical delivery and storing it in their own vaults. Why would they do that? Because they understand something that most retail investors don't. Paper promises are only as good as the institution making them. And when the system comes under stress, those promises evaporate. Let me tell you a story that illustrates this perfectly. Back in the early 2000s, there was a German investor who held a significant position in gold through a major bank. He had certificates. He had statements. Everything looked legitimate on paper, but he started getting nervous about counterparty risk. So he requested physical delivery. The bank told him it would take 6 months. He thought that was odd, but he agreed to wait. 6 months later, they told him there would be another delay, then another. This went on for over 2 years. When he finally threatened legal action, they settled with him in cash at the current market price. He never got his gold. Now multiply that story by thousands of investors. Tens of thousands. What happens when everyone realizes simultaneously that the metal they think they own doesn't actually exist? That's the scenario we're approaching right now. The London Bullion Market Association, which is the primary hub for global precious metals trading, has been experiencing severe delivery delays. Traders who are requesting physical settlement are being told to wait weeks or even months. Some are being offered cash settlements instead, often at premiums to the spot price just to avoid physical delivery. This is not normal market behavior. This is a market that's running out of inventory. And here's where it gets really interesting for anyone who's been riding this bull market in paper assets. If you've made significant gains in gold or silver ETFs, mining stocks, or futures contracts, congratulations. You've positioned yourself correctly for this macro environment, but now you need to ask yourself a critical question. When the music stops, what are you actually holding? Because there's a massive difference between owning a share of an ETF that claims to hold gold and owning physical gold bars sitting in your possession or in allocated storage under your name. The ETF can suspend redemptions. The mining stock can get nationalized. The futures contract can be settled in cash. But the physical metal in your hand? That's yours. Nobody can print more of it. Nobody can dilute it. Nobody can make it disappear with an accounting entry. Let me walk you through what's happening with the major gold ETFs right now. Several of the largest funds have been experiencing outflows, but their gold holdings haven't decreased proportionally. Why? Because institutional investors are redeeming shares for physical metal. They're taking delivery, and every ounce that leaves the ETF vault is one less ounce available for the next person who wants to redeem. The ETFs operate on the assumption that redemptions will be relatively small and manageable. But what happens when redemptions accelerate? What happens when the remaining gold in the vault isn't enough to cover the outstanding shares? They change the rules. They suspend redemptions. They offer cash settlements, and suddenly your paper claim to gold becomes a paper claim to dollars, which defeats the entire purpose of owning gold in the first place. Now, I want to address something important here, especially if you're sitting on substantial retirement savings. If you have $100,000 or more in traditional retirement accounts, there's a strategy you should understand. Gold IRAs allow you to hold physical precious metals within a tax-advantaged retirement structure. I've put together a comprehensive guide on how this works, including how to transfer funds without triggering tax penalties. You'll find that in the description below. It's worth reviewing if wealth preservation is a priority for you. But let's get back to the bigger picture, because the implications of this supply squeeze extend far beyond individual investment decisions. The commercial banks that have been shorting silver for years are now trapped. They've sold massive quantities of paper silver that they never actually possessed, betting that prices would fall or remain stable. But with industrial demand soaring and physical supply tightening, they're facing a nightmare scenario. If they try to cover their short positions by buying physical metal, they'll drive prices even higher. If they try to settle in cash, they'll face legal challenges and potential defaults. And if they do nothing, they're exposed to unlimited losses as prices continue to rise. This is what's known as a short squeeze. But unlike a typical short squeeze in stocks where companies can issue more shares, you can't print more silver. You can't mine it faster than geology allows. And you can't substitute it in most industrial applications. The shorts are genuinely trapped. And the evidence is everywhere if you know where to look. The COMEX, which is the primary futures exchange for precious metals in the United States, has seen its registered silver inventory drop to levels that would have been unthinkable just 2 years ago. Registered inventory represents metal that's available for delivery against futures contracts, and it's been declining steadily even as open interest has been increasing. That's a recipe for a delivery crisis. Meanwhile, premiums on physical silver coins and bars have exploded. You can see the spot price of silver on your screen, but try to actually buy physical silver at that price. You can't. Dealers are charging premiums of 15, 20, sometimes 30% over spot, and delivery times have stretched from days to weeks to months. That premium is the market's way of telling you that paper and physical have diverged. The spot price is the price of a promise. The premium is the price of reality, and this divergence is accelerating. Let me give you another historical parallel that's eerily similar to what we're seeing now. In 1980, silver briefly touched $50 per ounce during the Hunt brothers squeeze. The Hunt brothers were Texas oil billionaires who tried to corner the silver market by taking massive physical delivery. The exchanges changed the rules mid-game, implementing position limits and margin requirements that forced liquidation. The price collapsed. But here's what's different this time. The Hunt brothers were speculators. They were trying to manipulate the market for profit. What's happening now is driven by fundamental supply and demand. Industrial users need silver. They can't function without it. And they're willing to pay whatever it takes to secure supply. You can't change the rules to stop industrial demand. You can't force a solar panel manufacturer to stop buying silver. You can't tell the AI industry to build data centers without silver-based components. The demand is real. The supply is limited. And the paper market is built on a foundation of promises that can't be kept. So what does this mean for you? If you're holding paper gains in precious metals, you need to seriously consider converting at least a portion of those gains into physical metal. Not all of it necessarily, but enough that if the paper market experiences a crisis, you're not left holding worthless promises. And you need to do it now, while physical metal is still available at any price. Because once the broader market realizes what's happening, once the delivery failures start making headlines, once the ETFs suspend redemptions, it will be too late. The premiums will be astronomical. The wait times will be measured in months or years, and you'll be competing with institutions that have far deeper pockets than you do. I've been watching precious metals markets for over 2 decades. I've seen bull markets and bear markets. I've seen squeezes and crashes. But I've never seen a setup quite like this. The fundamentals have never been stronger. The supply situation has never been tighter. And the disconnect between paper and physical has never been wider. This isn't about timing the perfect top. This isn't about squeezing out every last dollar of profit. This is about making sure that when the dust settles, you're holding real assets instead of paper promises. Let me share one more story that drives this point home. During the 2008 financial crisis, there was a brief period where gold was actually trading at a discount to the spot price in the futures market. Sounds crazy, right? Gold trading below its own paper price? But here's what was happening. Institutions were desperate for cash. They were liquidating everything, including physical gold. But the buyers of that physical gold weren't the paper traders. They were wealthy individuals and sovereign wealth funds who understood that in a crisis, physical assets are king. Those buyers accumulated massive positions in physical gold at discounts to paper. And when the crisis passed and the money printing began, they made fortunes. Not because they timed the market perfectly, but because they held the right asset in the right form. We're approaching a similar inflection point now. But instead of gold trading at a discount, we're seeing physical trade at massive premiums. The market is already telling you that paper and physical are different assets with different risk profiles. The question is whether you're listening. Now, I want to be clear about something. I'm not telling you to panic. I'm not telling you to liquidate everything tomorrow morning. But I am telling you to take this seriously. If you've made substantial gains in paper precious metals, congratulations. You've been right about the macro trend. But being right about the trend and being right about the asset form are two different things. The trend can continue while the paper market experiences a crisis. In fact, a paper market crisis would likely accelerate the trend, as it would expose the true scarcity of physical metal. So here's what you need to consider. First, assess your current exposure. How much of your precious metals position is in paper form? ETFs, mining stocks, futures contracts, certificates? And how much is in physical metal that you either possess or that's stored in allocated accounts under your name? Second, determine your risk tolerance. If the paper market experienced a crisis tomorrow, how would that affect your financial situation? Could you afford to have your paper positions frozen or settled in cash at unfavorable terms? Third, develop a conversion strategy. You don't need to convert everything at once, but you should have a plan for systematically moving from paper to physical over a reasonable time frame. And fourth, understand the logistics. Physical precious metals require secure storage. They require insurance. They require verification of authenticity. These aren't trivial considerations, and you need to address them before you start accumulating significant physical positions. For larger positions, allocated storage at reputable vaults is often the most practical solution. You own specific bars with serial numbers. They're segregated from the vault's own inventory, and you can take delivery at any time. For smaller positions, home storage might be appropriate, but you need to think carefully about security and insurance. The point is, physical precious metals are different from paper assets. They require different handling, different storage, different planning. But in exchange for that inconvenience, you get something that paper can never provide. Absolute certainty that you own what you think you own. Let me address one more concern that I hear frequently. People worry about buying at the top. They see gold at $3,000 and silver at $67, and they think they've missed the move. But here's what you need to understand. If the paper market experiences a crisis, if ETFs suspend redemptions, if delivery failures cascade through the system, the price of physical metal will disconnect entirely from the paper price. You won't be able to buy physical gold at $3,000. You'll be paying $4,000, $5,000, or more, not because gold itself has become more valuable, but because the premium for physical delivery will explode. So the question isn't whether you're buying at the top. The question is whether you're buying before the premium explodes. And based on what I'm seeing in the market right now, that window is closing rapidly. The lease rate spike in October was a warning shot. The delivery delays in London are another warning. The premium expansion on retail products is yet another. The market is sending clear signals that physical supply is becoming constrained. You can wait for confirmation. You can wait for the mainstream media to start reporting on delivery failures. But by then, you'll be competing with millions of other investors who are all trying to convert paper to physical simultaneously. And the dealers, the mints, the refineries, they can only produce so much metal so fast. There's a physical limit to how quickly paper can be converted to metal. And when demand overwhelms that capacity, premiums explode and wait times extend indefinitely. I've seen this happen on a small scale during previous bull markets. Premiums doubled or tripled. Wait times went from days to months. And that was without a systemic crisis in the paper market. Imagine what happens if there's an actual crisis. If a major ETF suspends redemptions, if a large bank defaults on delivery obligations, if the COMEX changes its rules to allow cash settlement of contracts that were supposed to be physically delivered, the scramble for physical metal would be unprecedented. And here's the thing, you don't need to predict exactly when or how this happens. You just need to recognize that the risk is real and growing. The setup is there. The fundamentals support it. The technical indicators confirm it. And the market structure makes it increasingly likely. So what's your move? You can maintain your paper positions and hope that the system holds together. That's a bet on the status quo. It might work out, but if it doesn't, you'll have no recourse. Or you can start converting paper to physical now, while it's still possible at reasonable premiums. That's a bet on prudence and preparation. It might cost you some upside if the paper market continues to rally without incident, but if the system experiences stress, you'll be positioned correctly. To me, that's not a difficult choice. The asymmetry is clear. The downside of converting to physical is modest. You pay a premium, you deal with storage logistics, and you might miss some paper market gains. But the downside of staying in paper during a crisis is catastrophic. You could lose access to your positions entirely. Risk management isn't about maximizing gains. It's about avoiding catastrophic losses while still participating in the upside. And right now, the prudent move is to reduce paper exposure and increase physical exposure. Not because I'm predicting an imminent crisis, but because the probability of a crisis has increased substantially, and the cost of being wrong is too high. This is about protecting what you've built. If you've been smart enough to position yourself in precious metals during this macro environment, don't let a paper market crisis take that away from you. The window for converting paper to physical at reasonable premiums is closing. The market is telling you that through lease rates, through delivery delays, through premium expansion. The question is whether you're going to act on that information or wait until it's too late. I know what I'm doing. I've been systematically converting paper positions to physical for months, not all at once, not in a panic, but methodically, consistently, taking advantage of every opportunity to exchange promises for reality. Because I've studied enough market history to know that when systems come under stress, paper promises evaporate, but physical assets endure. The choice is yours, but the window is closing, and once it closes, you won't get another chance.